Welcome to Two Quants and a Financial Planner, where we bridge the worlds of investing and financial planning to help investors achieve their long-term goals. Join Matt Ziegler, Jack Forehand, and me, Justin Carbonell, as we cover a wide range of investing and planning topics that impact all of us and discuss how we can apply them in the real world to achieve the best outcomes in our financial lives.
Justin Carbonell and Jack Forehand are principals at Validia Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital or Sunpoint Investments.
All right, guys, today's topic is going to be about inflation. Jack has quickly become our resident inflationary expert over there, doing the research for this. So appreciate you kind of spending the time pulling all this stuff together, because there's going to be a lot of charts and graphs in this episode. So hopefully people can watch it on YouTube to kind of get the full and complete picture. But before we get into that, inflation's a tricky thing, but it's an important thing in the sense that inflation, effectively eats away at our purchasing power over time. So, $1 a year from now will be worth less in most chances than $1 today. And it's important for investors. So, let's say you have an investor that has a $500,000 portfolio. They can invest it in something that produces a return, or they can keep it in cash. If they keep it in cash over time, they're losing their purchasing power by not giving it at least the opportunity to grow. And so inflation is a very important, I think, concept for investors just to understand and grasp. And I think, in the past few years, we were in a very low inflationary environment up until, I guess end of 2020, middle of 21, whenever inflation really started to spike up. And that's been on a lot of investors' minds. And the Fed reacted, I think, appropriately. And now we're still in this camp where, depending on who you talk to, and we've had plenty of people on the podcast, Jack, that have some are inflation's going to stay higher for longer, while others are more, in the camp of the Fed has done most of its job here, and we're getting closer to the 2% target. But maybe to start, let's just start out by talking about why inflation is difficult to measure, and also why we shouldn't go nuts and paying too much attention about it, but just sort of talk about the components of what goes into driving inflation.
Yeah, the first thing for me is I was just thinking when I was doing the research for this, and I was thinking in January 2020, nobody cared about this at all. This whole thing I was researching, it just didn't matter. Inflation just didn't exist for so long that it's just funny. I don't know if you guys ever did, but I had no idea about any of this stuff. And I learned some in doing the research for this, but I literally knew nothing in January 2020 about this because there was no inflation and nobody cared.
I lived in terror of people asking questions about this stuff because there's so many definitions and things that if somebody's like, well, how does inflation matter here? How does real versus nominal matter here? And then you're like, wait, how do I track PCE versus core PCE versus are they just talking headline versus are they netting this? And I will confess, having to look those definitions up 1,000,000,001 times, because this is hard stuff to talk about as much as it is super, super important to talk about.
One of the things to your point, Jack, about that, though, I think one of the things that I was very wrong about is after the financial crisis and, during the 10 years after that with the Fed's balance sheet and all the monetary stimulus, I was always thinking to myself, inflation it's right around the corner. It's going to be here. And that was something I would think about a lot, and we never got it. And so I think we just all became super bias, or what's the word, just not paying attention, not thinking it could ever come back because we weren't seeing it from things we thought we might see it from.
Let me just go on the record and say a personal thank you to Cullen Roche, friend of the show, regular guest, for being one of the few people in my life in the early pre-MMT is everywhere phase who kept explaining why things weren't inflationary at the time and kept me tethered to humanity and thinking about stuff so that I didn't miss out on a bunch of years worth of returns. But yeah, I know that pressure was real and surrounding all of us all the time.
And to your point about living in fear about getting asked questions about this, I currently do, and you guys are about to ask me questions. So, because I had to basically come up with all this. This is not something I've known forever. I learned a lot doing the research for this in terms of what goes into CPI and PCE, and we'll talk about all that. But this is complicated stuff. There's a lot going on behind the scenes. And, I think you see so many people out in the media throwing numbers around and maybe not even knowing what those numbers actually mean, because they have a certain point they're trying, inflation is high, inflation is low, inflation is where target, where whatever they're thinking, like they throw a bunch of stuff around, but I don't think they totally understand what they're saying. And one of the things I want to ask Matt about before we get into this is inflation is really, really difficult to measure. And I think that's really important for all of us to keep in mind. Whenever we see there is no true inflation rate. Inflation is what's going on in your personal life with your own expenditures. And so it's so tempting to see these numbers and be like, oh, inflation's 4.5% or it's 2.7% or whatever it is. And we'll talk about what goes into these and all the things that lead to these numbers you see. But it's also important to understand that no matter what number it is you see, it's not necessarily the inflation rate that matters the most to you.
Inflation is always personal. We all have a basket of goods and services and whatever else that we consume, and we have offsets for those. If I'm working, I might have wages. If I'm retired, I might have assets or whatever else. So it's your basket of goods and services is your basket, and nothing in the media is ever going to reflect exactly your basket. So all that you can really do is have an understanding that sometimes prices are going up, sometimes prices are going down. Sometimes counterintuitively, your basket might be going down while everybody else's are going up, and vice versa. Having some methodology, having some way in your head, or working with somebody who can help you think this way is, I don't want to say worth its weight in gold. That sounds like an inflationary argument. Is worth its weight in something. It's useful because we have to understand prices just change over time. That's how this works. And the prices you pay, the prices you take, they're going to change over time too. This is the world we live in, and you can't ever, ever, ever forget that.
And a great example of that is housing. If I'm a person with a fixed rate mortgage who owns a house, or I'm a renter, like housing is going up, I feel those two things in very, very different ways. In one way, I'm actually benefiting probably from what's going on. And in the other way, my costs are going up. So it's just that's an example of how people feel inflation. There might be a number, we'll talk about OER and stuff like that later, but there might be a housing number in inflation, but how people feel that number is completely different depending on their situation.
Yeah, especially on the housing cost thing. This is one of those, like in the pandemic or whatever, and people selling one house to buy another. So I literally had this conversation this morning. Somebody's talking about, oh, we're going to sell this house, we're going to move. And it's no matter what, you have to live somewhere. Or at least, if you have wealth to live somewhere, this is part of the calculation. And so you can sell one house at an inflated price, but you might be buying into something else at an inflated price at higher interest rates. All this stuff is personal. All this stuff has to be taken into consideration, because then it's going to determine what pressures are you on in the next phase. If I owned a house for years and now I'm going to go rent, or if I owned one house and I paid off the mortgage and I'm going to go take on a mortgage to buy a new one, it changes the composition of money that I have flowing out. So these measurements, whether they look at rents or owner's equivalent rents or just home ownership or the cost of home ownership, and map all this stuff together, you got to figure out what it means to you, because you're the one paying the bill.
One of the most common or popular inflation indexes is known as the CPI, or the Consumer Price Index. That's what CPI stands for. And that's made up of a number of different components. So, Jack, maybe in your research, talk us through, I guess, what you learned about the CPI in terms of what the weightings of these things are, how it's calculated. I mean, what is the big sort of major insight here?
Yeah, we'll put this pie chart up on the screen, because this was a little eye-opening for me. I mean, I knew housing was a big part of the CPI, but I probably didn't know that it was as big a part as it is. You'll see from this pie chart, I mean, housing is 45%. It used to be less, but right now it's 45% of the CPI. So that's a huge, when we have all these debates about the lag and housing and stuff like that, it's having a huge impact on the overall CPI, because it represents 45% of it. And I don't need to go through all the percentages, but one of the things that was most interesting to me, and we'll see if you guys can figure this out, but like what's interesting is not just what's on this pie chart, but what's not on this pie chart. Like, what's the one thing that's missing from this pie chart that you would think would be a huge portion of CPI?
The price of Bitcoin.
That would be a good one, but that is not in there.
And I would say energy.
That's right.
Yeah.
So the answer is energy, and the reason is because energy is embedded inside of these other things. Energy exists in transportation, energy exists in housing, but energy also indirectly exists in all of them because energy is an input cost to a lot of this other stuff that goes on. So energy is kind of buried throughout this thing. But it was interesting to me to like see whenever you see any of these pie charts of CPI, you don't see energy because it's not one of the official categories in there. It's just, it exists within all the other categories.
On a pure planning thing, and this is one of the important exercises we take clients through, not on, again, there's a lot of embedded stuff and where you get to the assumptions, but when people have questions in the planning process about how do we think about inflation, we'll take a chart like this and you'll say, okay, this is CPI. So think about your own budget or your own outflows, your own expenses. But like odds are, and I can answer for myself, like 45% of my budget on a monthly basis for my wife and I, 45% does not go into our housing costs. And most planners will tell you like the rule of thumb is closer to like a third for things that you're going to spend money on. But take the snapshot of your life, think about where your money goes or what percentage of the expenses that are truly expenses goes, map it over this, see how close that rhymes for you. Do either of you guys, when you look at this, is there anything you're like, I mean, clearly, Justin, you're like 2.5% on apparel. I'm not going to dress myself. That's 25% or something, right?
Well, I don't know if that was the question I had. I don't think this isn't like these figures aren't the percentage, and correct me if I'm wrong here. This is saying like, take the 45%, that's a weighting. So if housing price inflation is up 3% year over year, that 3% is,
that's a 45% weight in the overall.
That's a 45% weight, right?
The overall
so
index,
I understand
correct.
it's supposed to represent, where consumers are, spending their money. But
it's supposed to be a representative basket of the consumer. Right. And it's something they change over time. Like it recently just changed, these things change, periodically, but yeah, it's like, it's impossible to figure out what a representative basket is because there's no representative person. They don't exist. And so they have to kind of average it out.
Because it's kind of interesting, like with healthcare, right? Like healthcare is 8%, but healthcare as a percentage of GDP is roughly 20% of our overall economy. And so it's like, and I think the 8% is probably accurate, like at a family level, barring any major healthcare catastrophe. But, with high deductible plans now and just the cost of healthcare, I mean, someone could easily have that be 25% in a given year if things go really bad. So, yeah.
I was thinking about this for myself, and this will be a good lead into the next chart. But like, basically, I've had like a bunch of healthcare expenses, like with our family in the last couple of years. So that would be a bigger portion for me. And as you guys know, I wear the same shirt every week. So the apparel would basically be zero. So like, it's a different, and as we get into the next chart here, that will show why it sucks for me, because basically apparel has gone nowhere in the costs. The apparel costs are not up at all. So I'm spending zero on apparel, which does not go up at all. And I'm spending money on medical care, which has gone crazy. So this next chart breaks down basically the change in each of those subcomponents over time. And it's basically what you would guess. Medical care has been going up the most. Housing's been going up a decent amount. And apparel has not been, going up at all. That's been the biggest lag by a good margin.
I mean, the one thing that kind of concerns me on this one is, I mean, if anything, there's like a shortage of healthcare workers in this country. There's more people that need, as the population ages, I just think the pressure on pricing there is going to continue to be very strong and probably drive those prices higher. I know that's a little bit outside the topic, but
no, I think that's true. What's also interesting is there's a lot of subcategories of all this. So for instance, if we were to carve college education out of education and communication, it would be the highest on this chart by a wide margin. It would be just destroying everything else. But there's other stuff in there, so it averages out over time. The other interesting one I found is that the food and beverage is just alcoholic beverages. So it sort of changes the way it gets dealt with over time, because people, like, their behavior in terms of drinking alcoholic beverages are very different than, like, I think they probably drink more of them in the recession. So it's a little bit different than like what you might expect.
Well, and what's crazy, sorry, Matt, I didn't mean to step on either, but look at like transportation in 2008. So that probably is the most volatile line on this chart. And I guess that kind of coincides with the values of transportation over time and during recessions and stuff.
I think that's right. I mean, I think the shipping and stuff is like that can be a very leading indicator of economic problems, like when stuff like that starts to tank. And that actually gets into maybe the next point here, which is this idea of core versus headline CPI. And the difference is basically, if we're trying to get the overall trend in inflation, we may want to remove certain volatile components that maybe bounce up and down a lot, and we're not getting at the overall trend. And so that's basically what core CPI is, and core PCE as well. And we get to that later. Like, you take food and energy out because they tend to be very volatile. But more interesting, like beverage stays in because it's alcoholic beverages. So it's an interesting thing. And the Fed tends to pay a lot of attention to core. So you'll always see it whenever you see any inflation reports, they'll usually report both numbers because the core is something that a lot of people pay attention to.
As alcoholics should. That's why this is all vodka in here. That's what this show's been brought to you
Matt's
today.
Matt's going to have some interesting insights by the end of the podcast about financial planning.
It's going to get real. It's going to get
Sponsored by Tito's.
Yes.
It is. Tito's, if you're out there, if you want to sponsor this thing, we'll be happy to take the money.
We'll even take Tostitos.
What about, I guess there's different ways to calculate it, right? Like over different time periods.
Yeah, and this is where you can get really in trouble. And it's just the different ways to calculate it and the different ways to exclude things. You have a lot of people will report year over year inflation. How much has it grown over how much is that basket of goods up over a year? But you'll also see things like 3-month and 6-month annualized, which are more recent things. And that can be really important because the 1 year thing can be very misleading at times. So like if you think when inflation first came on after 2020, when it starts spiking, those shorter term things are going to give you a better view of what's actually happening than the longer one is. And the same thing with recently where it's rolled over. You still had really high inflation readings in the annual one for a while, whereas the 3 and 6 month annualized were lower. And the big key with this is whenever you're hearing anybody who has an opinion on inflation, they basically have a full menu of options in terms of what they can come up with to verify that opinion. They have 3, 6 month, 12 month annualized, they have core, they have headline. They can start excluding other stuff outside of, the X, this, that, and the other thing. They can take things out. There's no matter what your case is, you can make it with this data. And that's why it's just so important to understand when anybody reports any inflation metric, what is actually in that metric? What's in the metric? Is it 3 month? Is it 6 month? Is it just month over month? Because if you don't understand that, you don't understand how valid what they're coming up with is.
The why am I reading this now to cite our friend Ben Hunt is one of the most important questions to ask whenever being presented with any one of these factoids, if you will. And it doesn't mean the fact itself is wrong or the reading is wrong, just understanding that it's always being presented or served up to you in a way that proves a point. And what you just said, it's not even just the constituents of what's in the different inflation measurement. It's the constituents, it's the time period, it's what things are corrective, what things aren't inside that time period. It's a friggin' mess, which is really convenient because it's kind of like proving you're right on the internet. You can almost always find a point on the internet to prove why you're right about something. You can also always find an inflation indicator to prove whatever crazy thing you want to say.
Yeah, Ben had a great tweet on, we talked about in our separate podcast, Breaking News, where somebody had effectively done an inflation figure like X, a bunch of stuff, energy, housing, food. Like they had basically taken like 70% of the CPI out as a way to show that inflation, is very, very low. So how valid is it when you've taken 70% of the basket out and now you're saying that's my case for inflation's low? And people who think inflation's high do the same thing. You can do it for anything. It's just you got to know what you're seeing. And it's so tempting in the world of social media to just see that headline number someone's reporting and be like, oh yeah, inflation's dead because of this number that's reported, or inflation is actually 7% because of this number. Like, you have to look behind the scenes and see what it is you're getting.
A real world ramification of this, without just punching at the pundits who say stupid stuff, is this can also show up in your own life. You might have something like you were talking about healthcare costs or whatever else before. There's a lot of stuff like this. Sometimes we experience a change in the cost of something in our lives. It might be dealing with some people who need to rethink the nanny that they hire because they're having an extra kid the other day. unexpectedly. Thinking about the way price changes can show up in our life, like as surprises as a point in time, we still need the tools and the language to identify what those things are and then what corrective mechanisms or protective measurements we can or can't take against that thing. Like if you have to move, if you sold your house and you have to move and real estate prices are running away, these are real problems people solve. So understanding all these different measurements can be useful to map back in all sorts of other ways too.
So let's talk about shelter a little bit and the components that go into that. And Jack, you had mentioned OER earlier, but just walk us through that methodology for that.
Yeah, one of the important things with shelter is to understand this is very hard to do. You've got people, like how do people live in places across the country? They typically will either rent the place or they'll own the place. And so you want to reflect both of those things when you think about how much shelter, the price of shelter is increasing. So you've got on one hand, so it's got two components. One hand is rents paid, and the other is OER, which is owner's equivalent rent, which is an idea basically that if someone owns this house, if they had to rent it, like what would it rent for? So what we're trying to do is get the consumption value of the house and not the change in value of the house, because this is like a CPI type thing. We're not trying to reflect like the change in home prices here. We're trying to reflect someone's consumption of housing. And so those are the two components. Is on one hand, there's rents paid, and on the other is owner's equivalent rent, which is basically if this house did rent, what would it rent for? Now, one of the interesting things on rents paid is what they're using is pre-existing rentals. So someone's in a rental, the landlord raises the price. That's what they're using in CPI. There's another way to look at this, which is what the Zillow type indexes you'll see look at, which is a rental is on the market. It's changing people. What does it rent for? And that's important because the speed at which the constituents those go after and the speed at which they change are different. When you start to see, like we did in 2020, you start to see a big increase in the market. Well, where are you going to see that first? The first place you're going to see that is in stuff that's on the market. You're going to see people like stuff that's up for rent right now. I can raise the price. If someone's on an existing lease, I can't raise the price. And so this gets into what we'll talk about in a second, but it's just important to understand like what's going on behind the scenes there, because there's different ways you can measure these things and there's no right way to do it. And they can lead to very different conclusions.
If just as a side note, like the whole data aggregation part of this is pretty amazing when you think about it. I mean, all that rent data has to be captured and then centralized. And, like what the Federal Reserve, has built over 100-year period in terms of being able to accurately get at this stuff is just pretty amazing when you think about it. To your point, Jack, or on the rents, I know Jeremy Siegel, when he was sort of right on inflation coming. And then I think he was kind of right also on inflation coming back down. One of the criticisms he had is this lag that happens with rents, that the falling rent prices because of the lease issue, doesn't get reflected in the inflation numbers as quickly as some of the other components, correct?
Right. There's two different things going on here. One is we're using currently rented properties, not properties on the market. So if you assume your average person, if you assume like 1-year leases are pretty standard, then you might say your average person might have like 6 months left on their rent. Like there's some people that just sign leases. There's some people that are coming to the end. So you could see there could be like a 6-month lag before there's even the potential for those people's rent to go up. So you see something happen in the market, it takes a while. The other thing is you can argue it's less likely if somebody's already in a property, it's less likely you're going to raise the rent on them than if you're putting in a new tenant. So that can also impact this. If I'm only using existing properties, it might be less likely that rent is going to get raised. And the second component of this is the sampling, which is, they take these rent samples every 6 months. So if you take the rent sample after 6 months, what they effectively do is they assume whatever happened in the prices of rent that went up 10% or whatever, they assume it equally happened over those 6 months. They don't have any data in terms of what happened inside of there. And so that can also create a lag because there's not going to be another sampling, depending on when it happens for 6 months. So it can be both of those together create a situation where this is lagging, what's going on in the real world. And going back to what I said before, there's other indicators out there like Zillow does one that try to track what's going on in the real world, and that they use changing properties versus the existing properties. And so that's why you can see these huge different numbers. The Zillow thing, if you see a change in the market, the Zillow thing is going to pick it up pretty quickly. Whereas, CPI is going to take a while. And that's what we're seeing right now. We're still seeing those price increases in owner's equivalent rent working their way through the system. And it's going to supposedly end soon here, but that occurred like a long time ago.
There's always the fascinating aspect of, especially with this stuff with like the rolling figures and the owner's equivalent rent and like the leases. So if we're working with a client who has commercial real estate exposure or is a commercial real estate broker or is all these different levels, it's kind of, you can also look at, or we like to talk to people about what they're seeing in different industries and where they see opportunities in this stuff too. Because it's like, because of all these lags, because of all the quirks in this thing, you can kind of tease apart where money is flowing in the economy because there's some weird bottleneck around what's going on. And it's really interesting to think about it too, with our investor hat on. What are the opportunities that are created by there's too much office space available, or the rents are going up because of whatever else, or somebody's trying to make something else fit? Like within all these measurements, do you guys ever think about through other ways that these measurements apply? I don't want to derail the conversation, but we do have conversations about, hey, this is a sign, this price is going up. Are you shifting your tactics in your real estate empire or in your commercial brokerage business to go like, this can't continue or this is a problem?
Yeah, I know. Whenever I think this can't continue, it always continues in my life. So, yeah, my tactics probably shouldn't be shifting too much based on stuff like that, based on my own personal track record.
So the next chart is showing basically the 1 year % change of CPI and housing prices. Basically, it looks like for the housing prices, it's using the Case-Shiller Home Price Index and then it's using CPI shelter. And I'll let you sort of comment on the chart. But one of the things that's kind of amazing to me, so the yellow chart is the 1 year change in home prices. And it just goes to show you would never have thought, like pre 2005 in this country, that you could have, housing prices go as high as, like, if you look at the standard deviation, right? It's like on the low end, you have like almost a 15% drawdown in housing prices. And on the high end, you have, so these are different. You have, I think on the left towards 05 and 06, you had, housing prices that were up 15% year over year. So, it used to be housing would appreciate, 3% a year, kind of like clockwork, maybe a little bit of variation, but then we had that bubble in real estate. And then obviously the great financial crisis, and then the big spike sort of after COVID. So anyway, it's just an observation with that. Jack, do you want to?
Yeah, no, you're right. I mean, we have had a lot of volatility here. And the point here is the same thing, the point I was making before with Zillow. Like, this is CPI shelter lags these real-time things. So if you look at housing prices, or if you look at like rents through Zillow, like you would see basically them moving ahead of CPI, this is just demonstrating the lag we talked about before. And, one of the interesting points I want to bring back on this related to the Zillow and the CPI is neither one of them is exactly right about this, because if you think about it, like if I wanted to get the actual change in rents throughout the economy, I'd probably want some blend of like properties that are on the market now, because some people are actually changing properties, and existing properties, because those people aren't going to see the extreme changes that probably for the properties on the market are. So it's like, there's probably like a blend of both of them not in terms of the timing, but in terms of like the groups you include that would make sense. Like, and that's why this is all so complicated, is like, there's just so much going on behind the scenes if you want to reflect that true consumer, but you also can't, because to Matt's point before, if I'm the person who's in the existing property, then that's the only one that matters to me. If I'm the person that has to go rent a new property, then that's the only one that matters to me. So it's like we're trying to create these averages, but they don't reflect any single person's specific situation.
But we still have to collect these averages because we still have to have some. Yeah. And that's like to be nice to the people collecting these averages. If we didn't have this data to try to start to make sense of some of this stuff, then there's so many other things you just can't do. And that's everything from Fed policy, to the degree you want to say you can or can't do Fed policy, to like planning about the future. Because that's really what a lot of this boils down to, is do we have some way of understanding how we want to approach planning about a future? And this stuff is really messy to gather to have useful information to make any plan with.
And it's annoying to some extent too, because it's like you're like, we have all this technology, we have these technology companies, like, give me the rate of inflation. Like, like, let's not have this lags by 6 months and this is this, and like, just give me the rate of inflation. And it's much harder said than done, but it's interesting to me, like when you think about the reactions to these CPI reports, like if it's 0.1% up or down, like there's this major reaction to it. But by the same token, we know that effectively, like a component that's 45% of the CPI is dramatically lagged with what's actually going on in the real world. Yet we care about this 0.1% once or up or down. Like it's just interesting to me, like that these measures matter, even if we understand there's like major issues behind the scenes in terms of if they're representing anything close to real world inflation right now.
Right. Because what does this do to your expectations over and over again with all these charts? Just like, what is this doing to your expectations? And yeah, the 0.1%, the 10 basis point change in the reported figure that sends markets off to do something completely chaotic. When you start to think about it like this, it's like, duh.
I mean, with Matt trading his interest rate futures, it's a huge deal. But, for the rest of us, it's not as big of an issue.
If I had a nickel for every, nickel I made on orange juice futures this year alone, it would just be.
And if we haven't confused you enough, we're going to now introduce another index, the Personal Consumption Expenditure Index, also known as the PCE. So what is this and how does it differ from the CPI?
So this is a little bit, this is important because the Fed likes this measure better. The Fed tends to pay a little more attention to PCE. It's issued by the Bureau of Economic Analysis versus the Bureau of Labor Statistics, which I don't even know why we have to have both of those things, but we do. And one of them does one and one of them does the other. And you can kind of see, so there's a bunch of differences in this first chart I put up. There's only really one difference we have to worry about. Like there's different formulas, there's different scope, there's all that stuff. But if you look at this pie chart in terms of what accounts for the actual differences, it comes down to weight. The basket is different for the PCE than it is for the CPI. And those weights drive a lot of the difference. And so if we go to this next chart, this is actually a cool chart I found on the web here. This actually shows the difference. And again, there's really one thing you have to concern yourself here with which gets to what Matt said before, which is 42% might be a little bit high for your typical person's, exposure to housing. Well, this kind of corrects that to some degree. This has 32% exposure to housing instead of 42% exposure to housing. And so that ends up being the major driver of the difference between PCE and CPI over time.
What probably concerns me the most about this PCE is 1.2% in tobacco. Jesus. What's going on with that?
Yeah, people are, the people are still smoking these days. It surprises me, but nonetheless, they don't want to hear from me about that.
Hopefully we don't have any, whatever.
When I'm futures trading, I'm also chain smoking. So I smoke enough for the three of us.
I think Jim Simons even quit, Matt. He used to be. He notoriously smoked his entire career, but I think he might have finally shut it down.
He'd be like giving interviews on the stage, be smoking.
Matt and his, in the office, all the people that had to work for him, all these mathematicians, the room's just full of smoke. It could have been the greatest, environment out there. By the way, just
clearly,
go ahead.
Let's say clearly the adjustment inside of the chart here is Jim Simons pre-smoking is on one side and Jim Simons post-smoking is outside.
I guess CPI does not account for Jim Simons directly as a separate line item, and PCE does account for Jim Simons.
That's where he's included versus excluded, yeah.
And just in case anyone doesn't know who Jim Simons is, he's the founder of Renaissance, probably the most successful, best performing hedge fund out there. Is it Renaissance Technologies?
Yeah. And just as an aside for anybody watching and for you guys as well, Acquired did Renaissance for their latest episode.
Really?
It's really good.
I haven't heard it yet.
Yeah, it's like basically a 3-hour deep dive into the entire behind the scenes story of Renaissance, which is a pretty crazy story. So I would definitely recommend that for anybody who hasn't tried the Acquired podcast before. It's really, really good.
All right. Moving on to the next, I think you were just highlighting housing's weight.
Yeah. So this is just driving the same point we drove on before, which is it just shows how housing is a huge driver of the difference between CPI and PCE. And over time, CPI tends to be higher than PCE. It has a little bit higher average. And, throughout this situation we've been dealing with here with inflation, it's also a bit higher. CPI has tended to be ahead of PCE. So that's just something to know. And this is a good chart, I thought, that drove home that point with a bunch of crazy bars.
So it looks like, given this next chart, that PCE is coming in lower than CPI. And to your point about the Fed sort of likes or weighs PCE more.
Yeah.
That's kind of this is a good trend in the sense, and it might play into like what I didn't listen to all of Powell's testimony yesterday or his press conference, but the market obviously liked what it heard. So I'm guessing, they're thinking they're closer than they are closer to their target, 2% target. And so,
yeah, they're sticking with
they're
sticking with three cuts this year. But what this is getting into is, so there's a different way to do this. So the previous ones are kind of these lagging indicators. It's like, let's look at what's gone on in the past and let's try to figure out what's going on and owner's equivalent rent and lags and all this stuff. There's another way to do this, which is let's try to create real-time measures of inflation that aren't as delayed. And there's kind of two ways this has been happening. One is the Cleveland Fed has something called the Nowcast, which is what this chart I'm showing is right here. So the Fed is they're testing different measures to say, like, can I do something that's a little more real time? And so what you're seeing in this chart is the year over year change. And again, you have to be careful, not 3 months, not 6 months, year over year, but year over year in the different measures. And you can see their real time CPI and core CPI are higher. Core is higher than regular and PCE is lower in both cases. So that's one way we're trying to do this on a real time basis. And the other way is the private market has tried to do this as well. This site called Truflation has created a very, I think a pretty complicated system to try to do this as well. And so they every day report a daily inflation rate. And so I pulled the one from today. It's 2.23%. So the idea being with their lower, with their more real-time data, they're getting lower figures than the Fed is getting in terms of inflation. So this, for those who believe in Truflation, this is an argument that inflation is lower than what we're seeing, in terms of the Fed numbers.
Jack, let me ask you this question first. They put true in the name. Doesn't that mean it's right?
It happening. Yeah, I think so.
Okay.
At least from what I've seen.
Even though they left out the E,
I think that makes
me skeptical.
I think that's like a stronger version of true. So I think it's even more true if it's in the name. Yeah. So all the stuff we talked about before about the different measures and everything, you can pretty much ignore that now. This is now true. So then this is the real rate of inflation. It's actually a pretty catchy name. You think about it. Like if you want to challenge the standard numbers and you want to put something out there that's real time, like Truflation is actually a good name to use for that.
It makes me think of, I've got one of the many Prince books and it's got all the letters that like Prince wrote and notes that he took to himself, like pictures of them. And he would regularly write, like, instead of the word two or TO or TOO, he would just write the number 2 and, C would always just be the letter. He's basically texting like a teenager before teenagers texted like teenagers.
Well ahead of the time.
Yeah, well ahead of the time. Morris Day and otherwise. Truflation kind of feels like that. I really appreciate too, in their very catchy graphics, that they also tell you the U.S. government also abbreviated reported rate below. I think that's really helpful to see under their number.
Yeah, how it contrasts. And the one thing I would point out with this is there is a downside to this in that a lot of the prices the Fed is using to measure inflation, or sorry, the BLS is using to measure inflation, are not necessarily observable on a day-to-day basis. And this is the point that Bob Elliott made when we had him on our podcast. We asked him about Truflation, and he's not a big believer in the accuracy of this number. And that's basically what he was getting at, is you have to be able to report pricing on a day-to-day basis. You have to be able to observe pricing on a day-to-day basis. And if a lot of the components that you measure are not measurable on a day-to-day basis or observable on a day-to-day basis, then you don't get an accurate number. So there's advantages to Truflation in that they are using real-time numbers, but there also, I think, are disadvantages in that they face a battle that they can't overcome in terms of some of this stuff just can't be measured on a day-to-day basis. And so you may not get a more accurate number because of that. So that's just something I want to point out on the downside of like these real-time type measures.
It's in just that word observable might actually be the most useful word in this thing. There's a reality. There's some of this stuff that is observable to you, just like there's some of the stuff that matters to you or doesn't really matter to you in this moment. And when taking these snapshots, understanding what's being included and not, it's a really useful word to use here.
I like to think that I can kind of go to a company's website, sort of figure out like what the business model is, but it's hard. Like I'm looking at this Truflation, like, yeah, they have this measure, but just trying to figure out like what they do is not that straightforward to me.
Yeah, I don't know that. I don't know if they sell premium data or if they,
they've got like some tokenizing and index-based stuff that they're doing. It's weird. They have this index and they have some pretty huge backers. It looks like they're they're well funded. But
yeah, and it's a
anyways.
great idea. You know, getting back to my point before, like we have all this technology out here. Like, why can't we get a more accurate measure of inflation? So they're actually trying to tackle that problem. The problem is it's just a very difficult problem to tackle because the true rate of inflation on any given day is not it's not a number you can figure out. So the idea is, can you get closer to it with this real-time data and with what they're doing than these lagged, PCE and CPI type numbers?
So let's get into why this matters or is important or how it affects investing decisions or different types of assets that are out there, and just sort of bookend this with some maybe practical advice. Cause we've kind of this has been good. We've gotten in the weeds on inflation, and there's, we could go on and on this topic for sure. I mean, this is really just the tip of the iceberg in terms of explaining at, a high level, what goes into inflation and the different ways that it can be measured. But, the point you made earlier, Jack, was a really good one, which was, up until 2020 or 2021, no one had inflation on their minds. And so it's hard to predict. And I remember somebody came on the podcast, and I thought this was really good. And, inflation is like toothpaste, right? Like when it comes out, it's very hard to put back in. So inflation can get kind of out of control if you don't aggressively attack it. And very, very high inflation for an extended period of time is not good for stocks, not good for bonds, not good for consumers. And so, those are the types of economic environments hopefully we don't experience in the future. Although, there's going to be periods of time, and we don't know when inflation could come back and roar, and really be damaging. But let's just talk through the implications from an investing standpoint.
Yeah,
how
so
we're thinking about this.
We basically just spent 40 minutes going through all these numbers, and now we're going to tell you why you probably shouldn't even care about any of those numbers. But that is the reality. Is like, if you think about it, and Matt can talk about it on the planning side, but if you think about it on the investing side, like, what am I going to do with my portfolio because of inflation? You almost have to have the decision made in advance. You can be one of these people that says stocks and bonds are enough. You can be one of these people that say stocks and bonds are not enough. I need other stuff in here. But you don't want to be the person who's switching between those two camps. You don't want to be the person who's looking at these numbers and being like, oh, inflation's 4% or 2% or whatever it is. So let's think about making some changes, because not only is future inflation very hard to predict, but how the reaction to future inflation is also very hard to predict. So trying to buy anything, obviously if I thought I could predict inflation and it was going to spike, to 8%, I probably got a pretty good chance of buying commodities and doing pretty well. Like, commodities track inflation pretty well. But like, how am I supposed to know if inflation is going to track back to 8%? I mean, it seems like it's unlikely going to do that. So that's the challenge on the investing side, is you almost have to have, you want to have your long-term portfolio, and you can be a believer, all I need is stocks and bonds. You can be a believer, I need other stuff, but you've got to stick with that, and you've got to avoid the trap of inflation spiking. So let's buy this. And, now it's back down. So let's sell the commodities, because that's a losing battle.
So now that Jack said inflation's hard to predict, I'm going to make some predictions here.
You are.
The Jonathan predictions are coming in. No, it's just a couple, just some things that, I'm thinking about. Like, obviously technology is very deflationary. And with AI, and I think the impact that it's going to have, you wonder if that, combined with the baby boomer generation retiring and sort of, spending less, you wonder if like those deflationary forces are going to be so strong and that's kind of like where it's going to be like an anchor to pull us back to this lower than average historical inflationary environment. And who knows? It's just, thinking about what's happening with technology, what's happening with the world. Then the flip side of it, you could say like deglobalization is more inflationary. So as we bring more stuff back here and create it in the United States, which is more expensive to produce, maybe that's going to put upward pressure on inflation. So you kind of have these global things that can have, these pretty big impacts when you kind of try to think about them from a high level, I think.
Yeah. And to your point, like, there's been three drivers of deflation, of low inflation over time, not deflation, but lower inflation. You have technology, you have demographics, and you've had globalization. So now we're in a situation where two of those are still likely deflationary, but the other one is not anymore, or disinflationary. The globalization one has kind of gone the other direction. And that's why this is so hard to predict, is we just don't know. Like, you've got two different things with inflation. You've got cyclical inflation and you've got structural inflation. And so the big quiz, inflation is going to bounce up and down, even if we're in like a 1970s, which I don't think we are, but even if we are, the 1970s had big moves down in inflation as well. So your cyclical inflation is going to be all over the place no matter what. What you're getting to is the idea of structural inflation. And that's the big question right now. And also, like, populism in general is kind of a driver of this too. If we're going to take money from corporations and we're going to give it to people, that's inflationary. So the big question is the structural inflation, and those major forces, like, once we get through the cyclical parts of this, are those major forces going to drive a new, like, more permanent, higher inflation level? And, it's above my pay grade to figure that out. I mean, that's why we have you here.
Yes, it's clearly within my pay grade to now tell you the very truflation number. So it's fascinating to me how these things both stack up and can be measured. It's fascinating to me how you have to think, and to, like, the deflationary point. Okay, AI is going to take all these things and drive costs down, to which then you also have to go, well, if we have AI, then we need all these servers. And if there's less globalization, then what are we going to plug it into? Where's all the energy going to come from? And isn't that part inflationary? And over and over again, I go back to this. And I believe we covered this in another episode, but it's this concept when I'm explaining stocks may or may not be a great inflation hedge. Maybe they're correlated, maybe they're not. We know something goes into the input cost decisions. If we think about just a McDonald's, and we just literally think that any store, any operation that has to be in business has to figure out their input costs, has to figure out how much it turns to turn the lights on every morning, how much it costs to get their inventory, pay their workers, all these types of things. We're always trying to think at least a day or a quarter or a year into the future and figure out, how do we basically charge more than it costs to continue to run this business? And that's true for your household. That's true for the stock that you buy. That's true for, in an abstract way, even the governments of the world. And so when we think about inflation and we think about all the things we're not going to know about what it is or where it's going, we have to at least inventory the stuff that we know we have to pay out as an expense. And we have to kind of set prices accordingly to what lets us play the game another day. That's a hard thing to think about, but you can't not, double negative. You can't not think about that stuff. You got to make the list of all the stuff you're going to pay for and make sure you have a justifiable reason you're going to survive to fight that next day. So whether it's financial planning or thinking about it in the investing landscape, we're relying on companies when we invest in them. When we're loaning money, we're relying on some of the assumptions that are in that loan for the money that we're going to get back at the end, that's going to make sense. That is a foundational building block of finance. That's why this stuff is so infinitely interesting, even if it's not true in the 2 + 2 sense. It's true in the sense that this is reality. We have to deal with it sense.
Yeah, one of the things you and I talked about offline, and I thought it was a really good point you made, is this idea about thinking about inflation more like directionally than exactly. Like, the idea is, Matt hasn't prepared a financial plan for me. I've got 3.5% in there. It's 3.7 now. Let's like get that thing in the fireplace and let's start over. But, like, it's almost like I have to think about this in terms of the major moving parts versus the exact numbers, because people get trapped in this. We see these exact numbers all the time. Every time there's a CPI report, we see these exact numbers, and it's like, oh, do I need to change something because I saw these exact numbers? And I thought that was a good point about, like, thinking about it directionally.
And I want to take it back, Justin. You made the point about, you said, like, before 2020 or whatever, you didn't have to think about inflation. Most people did not. Anybody, let me tell you, who had college age or near college age kids was really thinking about inflation. They might not have been thinking about home price inflation. They might not have been thinking about prices at the pump, but they were thinking, how much are these tuition payments going to cost? Being directionally aware of what prices you have in that big checklist. So being aware of what those things are in your checklist of things you're going to have to expense, and then being directionally aware of which direction they're headed in. That's kind of the best any of us can do at the individual level to understand this stuff. Because if I'm a retiree, I might only be thinking about my healthcare costs and, whatever else. If I have kids going into college, I might be over over-indexing to how much are those tuition payments are going to be. And if I'm a young person who doesn't own a house yet, or you're thinking about having a kid and buying or whatever else, you might want to over-index to those things. My wife and I have to buy a house in the next, couple of years, or we think we'd like to. We're renting right now. Inside of that decision, I care more about real estate prices right now than I've cared about in a hot minute. And that's just because that's a future expense to me. That directional awareness that's such a huge point.
I think one thing that investors sometimes forget is that the returns that they get have inflation in there. And the reason I'm thinking of this, Jack, you just interviewed Rob Arnott the other day, and we were talking about his interactive asset allocation tool. And I believe they give real and nominal returns.
I love that tool. You can do real and nominal. It's a beautiful looking tool. I just click on it and it makes me happy. It's way more, I get a way better, higher like dopamine hit from that tool than I get from the Truflation tool.
I want to see the episode of Matt just plays with the research affiliates tool for an hour. That'll be our next episode of the Edge of Two Quants and a Financial Planner.
Not all superheroes wear cape ratios.
Nice. Let's do it. But no, I think, when he talks about returns, he always talks about real returns. But like you said, you can do both on the website. So anyways, that's just a point that I thought was worth bringing up.
Yeah. And when they're not that different, like they have been for, until 2019, they weren't that different. It's not that big of a deal. But like if you lived in the 1970s, the difference between real and nominal returns was a big difference. Like with the stock market in some years was doing pretty well nominally, but like when you started taking out those huge inflation rates, it was a very different world. And, when you got into the real world.
Do we want to end with sort of, I guess, two other things with, I guess, one investing and then one planning with sort of inflation and factors. So, what type of stocks might do well in different inflationary environments, which I think might be a little bit more interest rate driven than those, but interest rates and inflation kind of go hand in hand.
Yeah. Well,
what are we thinking there?
What's interesting is that's something in theory everybody thinks. You want to buy the value stocks, in high inflation and high interest rate environments. And when you look at like from a discounted cash flow perspective, that makes complete sense. I mean, value has more of its value in the present, growth has more of its value in the future, but that sort of breaks down with the data. And what's interesting about inflation versus interest rates is it's a little bit of a different conclusion. Like the relationship for most people I've seen who have looked at it, the idea that you want to buy value stocks in like high or rising interest rate environments, it doesn't hold up. In the long-term data, you really don't get any better return from it, but you do a little bit in inflation, higher rising inflation. So it's interesting. There's actually a little differentiator there. Like you do typically get a little bit better return from value during periods where inflation is higher rising. Now, having said that, it goes back to my original point before, like, should you do anything with that? No. Like, are you going to time when the inflation is going to be high and, add your exposure to value, and then you're going to be wrong for 3 years. So you're going to abandon it because it's not working. Like in the real world, like trying to use these things to add exposure to factors doesn't make any sense. But it was interesting to me, at least that thing about interest rates that everybody says, value stocks perform better in high interest rate environments. It doesn't hold up in the data. You would think in theory, it makes 100% sense. But in the data, it doesn't hold up as well as you would think.
I think what fascinates me about that and these points is this is one of those connect it back to building and operating real businesses. And by all means, treat your stocks and your equity portfolio as ownership stakes in real businesses. This is when it's actually a useful exercise. Because if we reduce it just down to talking about it as the value factor, and that might be well and appropriate for constructing the portfolio, but also understand it as it's kind of like in 2008, when nobody can write a mortgage and everybody wants to sell real estate, it was a really good time to buy real estate. Like that holds true. You want to hold that stuff for when nobody wants to own it and it's cheap. That's what value investing is. Conversely, on the flip side, when there's inflation and everything else and stuff is going up, there's a time and a place when it makes sense to hold that tangible asset that you acquired when it's cheap. And there also is a time to unload that thing. Connecting it back from not just what does the factor represent, but what's the economic reality of the factor that you understand it, and reducing it back to a real world business, I think is a insanely useful exercise for thinking through this stuff too.
By the way, Jack, that data is AQR. Where is that coming from?
From a bunch of different places. We had Matthias Hanauer on the podcast. He put up a chart of that from Robico. But yeah, pretty much anybody, like across the board, they've they've kind of found that the relationship with value and interest rates. And I'll try to go back and put a chart in the podcast when we do it, but it doesn't hold up as well as you would think. It makes a ton of sense in theory. It does not make as much sense in reality.
Matt, what about from just a planning standpoint? How do you work with clients when you're sort of looking at inflation or the directional side of inflation, or how does this kind of flow into the planning process?
This is when the budget and all things for us go back to, as I've said a million times on here, it's what's the calendar, what are the cash flows, money in, money out, how they map over the calendar, and then what's the balance sheet that results, which is if the cash flow is a surplus, what assets am I building? If the cash flows are in deficits, what debt am I accruing or assets am I spending down? And in financial planning, the budget, it exists somewhere inside of that cash flow statement. And it exists somewhere in not necessarily how much you spend on olive oil at the grocery store, but what are the things that we expect to spend money on? Your basic stuff, like if you're going to own a house and live there for 10 or 20 or 30 years, we're not going to worry so much about there's no owner's equivalent rent once you bought the house in your financial plan. But there is a maintenance capital adjustment that we'll usually put on the value of a home. We'll generally say on the value of your home, you're probably going to spend 3% on maintenance costs in a given year. And if you don't spend it in one year, expect to spend 6 in the other. So we try to model stuff like that in again. One of the most useful things where I think, model in an inflation assumption is in places like college and places like healthcare. Places where a surprise of an above average rate of growth could really be a negative shock to your plan if you haven't set extra money aside to do it. And those are cases where you might have with a retiring couple or something else, you go, how do we want to think about long-term care costs or something like increased health needs as we get on in life? And you might want to actually break that out and apply a higher inflation rate to the present value of that number. That's the places. College, I brought it up earlier. You have kids going to college in a few years. And this was certainly the case in 2020, where we would be saying, yeah, inflation is effectively zero. You're not going to get any money on your cash, but we still want to be making sure that college expense is going up by, I forget what the number was, but 6 or 7% a year or something. It was meaningfully higher than the regular inflation rate, but such was the tuition data for, in-state and out-of-state schools for most clients. So on a financial planning perspective, it's understanding on your cash flow statement what you have going out the door, and if we need to index any of those where we really want to be cautiously aware of how much they can go up. Very, very specific to the individual, and very, very specific, Jack, to the point you made earlier of we just want to get this directionally right and probably err on the side of caution wherever we can.
Yeah, on the maintenance budget thing, Matt, I wish I had budgeted for a plumber instead of Jack tries to change cartridge and kitchen faucet, because we are currently on that project. And I think the end result of that is going to be spend more money than plumber, and Jack does tons of work on kitchen faucet. So I think I'm going to lose on both fronts there.
It's a stupid line item that we try to add to plans or when we talk through with people, especially when when they're not renting and they're in a house for a long time, is to actually think. And again, the key is, say you use 3% as the number on your house. And there's background stuff on that I'm glossing over here, but just say you use the 3% number. The most important thing is to realize you might have a year when that cartridge doesn't go bad. And man, I had a previously owned house, a nightmare with a cartridge and a shower thing that I thought I could fix for myself. And man, that was a battle that ultimately, I hope you don't find out it's not even the problem you think is the problem because you thought you could figure out the problem, but the internet lied to you. That's what happened to me. It's 6 other repairs later.
It ends with the arrival of the plumber, basically.
It ends with the arrival of a plumber and a new heating unit and several other things. But the reality is, even when you own a home, as I have in the past, you go through, you might have a year where nothing really goes wrong, but then you have another year where everything goes wrong. And the funny thing is, if you just say, set aside 3% a year for maintenance costs on the house, I'm just saying it can go a long way. Even in a year when you don't use it, if it's getting sidecar bucketed somewhere, you can be really happy when you go like, we didn't spend the 10 grand last year or whatever it is, or the 5 grand, but like that 10 or 20 grand expense is coming. It always is. That's the joy of home ownership.
So we'll wrap it up in a second. And this might be a good topic for you guys to explore with Ben over at Breaking News. But an article caught my attention about grade inflation. So inflation can happen outside of the financial world. And what they found is...
This is worse than tooth fairy inflation, by the way. This statistic. I saw this online. This is staggering.
And especially with Jack and I, young kids. So they're finding that teachers are grading their students' papers and work higher in order to just overall give better grades. And I don't know if the article pointed this out, but it might. And the other thing that was floating around too in the last week was like, how test scores, especially for the, younger kids that with COVID and stuff, they're finding that, they're lower than they've been historically. And so anyways, the grade inflation might be a result of trying to make things look better than they actually are in the school system. Anyways, that's a topic for maybe you guys to explore with Ben Hunt on Breaking News, but kind of coming outside of the financial arena.
Yeah, I thought I saw something at some point that like even like up through college, like a lot of these Ivy League schools, like you either get an A or they consider it like failure. So they're like just giving out A's. Like almost everybody is getting A's these days because like it's a failure basically in the way you view it, at least if you don't get an A.
This is the stuff that's like a mess. And as somebody with teachers in the family and whatever else can attest to, this is one of those things where you have to be aware of what the layers of correct are and the people are around you. And who knows? I mean, for all my generation often like was criticized for giving trophies to too many kids. Now, I don't know, maybe too many kids are getting A's in English class when they can't even send a text message with the proper your in the statement, right?
Yeah, that's true.
It's kind of a mess.
Yeah.
A non-pop culture story, although I was thinking earlier that like a good way to think about this too is you could think about like at the Super Bowl, like who sings the national anthem and how often that changes over time. That feels like inflation. That feels like things that we can choose to like or choose to dislike, but all agree upon as happening in the real world. Why does, Whitney Houston sing in 91 and, Garth Brooks in 93? And does anybody remember Jewel singing the national anthem in 1998? I was looking this up earlier. But I'm thinking about, do you know about the size of the cockpit for Air Force pilots? Do you know this story?
No.
About like setting this? This is perhaps as useful, if not more useful than the planes getting shot down thing. So they had this World War II, later 40s, so post World War II, where all these pilots were crashing, and they do this big internal study, and it effectively says that the problem isn't human or mechanical error, but the design of the planes itself. And as you can imagine, post World War II, there's a lot of these things. So the standards for how they built these planes and set in the cockpit, they all the way go back to 1926, when the government is trying to figure out how to build planes because of, wars. So in the 50s, the military commissions a study. They capture 140 dimensions of over 4,000 pilots. Jack, in your research of the inflation numbers, do we have 140 dimensions of 4,000 different inflation indicators yet?
I do not think so. I think it is less than that.
Okay. So this junior researcher, this guy, I think it's Lieutenant Gilbert Daniels. I have an old cultish creative post on this. I'm not remembering this off the top of my head. But he recognized the flaw in the approach. And the takeaway was, or one of the takeaways is, he's like, in calculating the average hand, they ended up with a theoretical hand that no person actually had. So of the 4,000 pilots, the 8,000 hands, not a single person actually fit the hand that was being used in the model for the cockpit design. And that's kind of a profound thing. And that's kind of like what's happening with these inflation numbers. So if Daniels goes further to actually show that not even one pilot was average on as few as 10 of the dimensions in the actually produced thing, and were reduced to only 3 dimensions, about 4% of the population was actually a fit, because there simply was no such thing as an average pilot. They had tried to make a cockpit for everyone and instead designed a cockpit for precisely no one. And this turned out to be the source of the crash problem. With inflation and all this stuff, it's just we're agreeing on average and we're agreeing on something we're going to measure average by. But the reality is nobody experiences it this way. You experience it in one of the many flavors of ways. You invest in a portfolio that's an exposure to many of these flavor ways. Just be aware of it. Like the Air Force pilots, this is a mess to calculate and plan for this stuff. And sometimes the answers just aren't as clear as they seem. Jack, I'm so happy you dove into all this data because I am consistently overwhelmed with the number of ways you can measure inflation.
And by the way, my favorite national anthem of all time, Chris Stapleton. I don't know if you.
Oh, that was a great one.
I think maybe I don't remember some of the older ones, but that one was outstanding.
Whitney Houston, I think, is my top of all time. It's a weird thing. The end of her national anthem is one of those things that I think I hear in my head automatically and remeasure everyone else's national anthem on forever. But okay. Do you have a favorite national anthem, Justin?
I mean, I thought Jack kind of, I mean, maybe it's recency bias.
Stapleton was
Stapleton.
Good. Stapleton was really good.
What are some of the others? Just real quick, Matt.
Oh man.
Let's see here. Or no?
Yeah. No, I have. And it's also interesting that they didn't always sing the national anthem. It was the Star Spangled.
I'm surprised Jewel. I didn't realize Jewel in '98 was like that big of an artist.
I mean, who will save your soul and sing the national anthem except for Jewel?
There you go.
Mm-hmm. Yeah, and there's lots of weird ones too. Like, I mean, some of the highlights, you had Barry Manilow in 1984. I thought that was a good one. Herb Alpert played it just on a trumpet in 1988. That was a fun one. We got Backstreet Boys in 2001.
Yeah.
It's also really interesting to look at like who bookends the different people. Like we had like Kelly Clarkson in 2012 and then Alicia Keys in 2013.
Okay.
Idina Menzel, that's the Frozen lady, I think, right? She did 2014. Pink in 2018. I actually remember that being a good one. Gladys Knight killed it in 2019. I remember being excited by that. I remember being confused about Demi Lovato in 2020. It's not that she did a bad job. Here's the real one though. Predict the future. Do you know who's singing it in 2024? I know they told me this. I forgot, and then Wikipedia retold me.
Oh
this.
wait, hold on. I haven't Googled this or anything. Is it the Is he kind of like is it Jelly Roll or?
That would be awesome. I mean, maybe they've changed it in Wikipedia's link to update.
What
this was a throwback. I wasn't ready for this one. Reba McEntire, apparently.
Oh, cool.
Reba, who in age inflation still looks the same for the last like 20 something years.
Yeah,
we'll sing your next.
She sang it this year, correct? 2024, right? Yeah,
it's in Wikipedia in my memory.
What is it? So I still have a chance to get that right, dude.
You have a chance to get it right. Jelly Roll for 2025.
That's our vote. All right, guys. Thank you guys for listening. We'll see you next time.
Hi, guys. This is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at JJCarbino and follow Matt on Twitter at CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.